From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro. A bit of a reprieve after yesterday's sell-off that led to a correction in the NASDAQ. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, futures rebounding at the end of an ugly week for markets. Amazon providing a boost after big tech enters a correction. And another key piece of economic data comes in ahead of the Fed. We begin with the big issue, looking ahead to a critical week for markets.
We look ahead to next week.
Next week when the FOMC meets.
What to expect from the Fed next week.
Next week's policy meeting.
We'll have a more hawkish hold from the Fed next week.
Beating that drum of higher for longer.
Maintain a very hawkish narrative.
They are also not talking about rate cuts, and we are not expecting rate cuts to come.
It's this give and take that the Fed has to manage.
The continued strength of the economy actually handcuffs the Fed.
The economy has much more resiliency.
The resilience of businesses, the resilience of the consumer.
The labor market that is just, very strong.
A pretty strong labor market.
The Fed is looking at all of these data juxtaposed with inflation that's still too high.
The Fed is not looking to tip the market into a recession.
Everybody's wondering what these lagged effects of rate hikes are going to be.
Joining us now to discuss, Nuveen's Tony Rodriguez and Margie Patel of Allspring Global Investments. Tony, I want to start with you. How important is the Fed versus the Treasury refinancing agreement? In other words, is economic data in the driver's seat?
Well, good morning, Lisa. Good to be with you. Certainly for next week, I don't think the Fed is all that important. We know that they're not going to hike rates. I think it's pretty much consensus that they're going to have what you would call a hawkish hold. Right now, there's really no incentive for them to do anything but that. In terms of the refunding announcement, I think that also is news that the market is understands pretty well. Supply is higher. Funding needs are being pushed out into the long end of the market, and that's certainly pressuring the long end of the market. So ultimately, we do think it's the data that's going to be most important. What do we see? Today's data was important. What's happening with the employment report at the end of next week, I think, will also be very critical for prospects for growth as we move into 24 versus the rearview mirror look of GDP that we got this week.
Margie, your take? Margie, how much are you looking next week to what we hear out of the Federal Reserve versus the economic data?
I can't hear. I mean, I'm getting two sounds at once.
All right, well, we'll try to work that out. In the meantime, we'll stick with Tony, and we'll bring you back in when you have a better connection. Secretary Yellen, meanwhile, discussing the recent run-up in Treasury yields yesterday caused a lot of discussion. Take a listen.
We're seeing yields go up in most advanced countries. Part of the increase in yields, I think, is simply a reflection of the strength of the economy, the notion that interest rates will be higher for longer.
This arguably is somewhat political. Tony, your view, though, on how much angst about the deficit really has underpinned some of the fluctuations this week?
Sure. And I think, obviously, Secretary Yellen did need to basically say that most of the increase in yields was due to growth and not due to supply pressures. From our perspective, we'd say it's probably about half and half, maybe 50, 60% is the stronger growth that we've been seeing in the economy. But certainly close to half of it is from the increased supply and the fact that there's some uncertainty around demand for that increased supply. Certainly the Fed is no longer a buyer. In fact, in QT, when you look at some of the global players in the market, whether it's due to high hedging costs or economic pressures in their own countries, you're seeing lower demand as well. So we think that the demand will be replaced by buyers in the U.S., but in either case, there is a significant portion of this increase that has to do with supply pressures, with deficits that are much too high, and really no prospects when you look at what's happening in Congress for any kind of reduction over the next couple of quarters.
Tony, you said that economic data still matters quite a bit. I was surprised by the reaction yesterday to the strongest GDP growth that we've seen in more than 2 years, or almost 2 years, I should say. We saw incredibly strong, stronger than expected personal spending just moments ago. Are you surprised that Treasuries didn't sell off more in response to some of this?
At the margin, we think that The 10-year around 5% is very attractive. Right now, it's a bit below that, of course. I would have expected to see a little more pressure upwards. But as I mentioned before, that data is more rear view mirror. A lot of the forecasts that you're seeing for fourth quarter GDP are down in the 1 to 1.5% neighborhood. So we do think this was a little bit of a, near term driven by inventory buildup, for example. So you're not going to see that repeated. So I think as you look forward, which is what the market is doing, we've already had a significant increase in rates to reflect stronger growth that we saw in 2023. And now I think the market begins to look forward to 24, which for us, and I think for much of the market, is a much weaker growth picture than the 5% that we just printed.
We get more key U.S. economic data out this morning. Bloomberg's Michael McKee joining us now. It's that sentiment survey that John always complains he doesn't get a call from and would love to. Mike, what are we expecting?
Well, I think people are reasonably happy, or at least they were during the month of September, because income and spending both came in fairly strong, not quite as strong as anticipated on the income side, up 0.3. The forecast was for 0.4. But you take a look at what we see there, and you see for another month that spending up 0.7 during the month outpaces incomes, which raises that question of how long can the consumer keep doing this. The savings rate continues to fall as well. But the question isn't really whether it's savings that's high or not. It's usually people spending what they make, and wages come in at a decent number, 0.5% up in August, 0.4 in September. People are still making money in their paychecks, and they still seem to be able to spend it. Disposable income unchanged on the month. So then the question becomes, what do people do going forward? Incomes and spending got to match up at some point. And as you can see there, the savings rate coming way down, and people spending more than they bring in. Lisa, looking this morning after these numbers at the WIRP function on the Bloomberg, it's a negative 0.5% chance the Fed does anything on Wednesday. Nobody thinks they're going to do anything on Wednesday, which is why that whole Janet Yellen thing is interesting, because a lot of people in the markets are saying that the refunding announcement is going to be more important than the Fed, since the Fed, everybody kind of has an idea what they're going to do. Yeah,
Ian Lingen earlier this morning making that point. Michael McKee, thank you so much. Still with us is Tony Rodriguez. And I am curious, Tony, how much are you seeing this idea of greater spending really bleeding through to a positive corporate picture at a time where everybody was so worried about borrowing costs, but they've been offset?
Yeah, you make a great point, Lisa. The top line for corporations is quite strong. Consumer spending is the driver of the economy. It's why the economy has been much more resilient in 23 than most people, whether it was forecasters, the Fed, or ourselves, thought it would be. But again, we think that's really just pushed out the slowdown that we're expecting in the economy. Ultimately, the consumer is going to exhaust their excess savings. They've already gone through a little bit more than half of that from our projections. And when you think about what's happening with wages, a lot of the growth in wages is slowing down. We look at the Atlanta Fed wage tracker. That's come off. It's still too high to be at a comfortable level for the Fed, but it's moving in the right direction. You add in things like student loan payments coming back in, the bite from higher rates, certainly on durable goods, autos, home prices, et cetera. All of that, we think, will prove to slow consumer spending as we move into 2024. And that's what's going to relieve some of this upward pressure on longer term rates that's been so acute over the last 2-3 months.
So what do you prefer, corporate credit or full faith and credit U.S. Treasuries?
That's a very good question. We do think that for conservative investors, when you see a 10-year north of 4.75%, that becomes an attractive level to begin to take on some duration risk, earn a high level of income. So we're very comfortable with kind of high quality, longer duration corporate credit. But we do like to dip down into below investment grade, as long as you're only going down into the higher quality segment. So think double B credit, higher single B credit. There we think you're going to be able to earn a very high coupon and have a company that is going to be able to withstand the slowdown that we're expecting, because we're not expecting a hard landing. As you move into the lowest quality segments of below investment grade, those are the companies that I think are going to experience the most stress. And that's where you want to be a lot more careful in terms of your credit exposure.
Tony Rodriguez, stick with us. Thank you. Margie Battelle, we are trying to reestablish her connection. Our apologies to her for the technical error. We want to get to some of the stocks moving ahead of the opening bell. Here's Abigail Doolittle. Abby.
Well, Lisa, we are, of course, looking at a bit of an updraft for futures overall, and a big piece of it, big tech. Amazon this morning is rallying in a very solid way. Investors encouraged by the robust e-commerce sales in the quarter that was, and the possibility of a stronger cloud business next year. So looking forward to the future. The stock up 6%. Operating margins beat by more than 200%. So the company did not sacrifice the bottom line for research. Instead, they put up a clean quarter. In addition, Lisa, this stock has been on sale, as you know, down about 12% over the last couple of weeks. So investors snapping up. Intel also sharply higher, up about 7%. They beat and boosted their outlook on a recovery in PC sales for the fourth quarter. They're now looking at a range for sales of $14.6 billion to $15.6 billion. The entire range over the estimate of $14.4 billion. Plus, they're looking at a profit of 44 cents versus 31 cents. Analysts very positive, saying that a turnaround is underway. And then ExxonMobil, not so much. The stock up a little bit, but they missed earnings and revenue, similar to Chevron. This has to do with weakness in both refining and chemicals. They boosted the dividend and the fat cash flow beat estimates. So maybe that's holding the stock up right now. It's interesting right now, Lisa, because overall, about 1% of companies are beating sales estimates, about 7% earnings, and yet stocks mixed. But this morning, we're having a positive reaction.
Abigail, thank you so much. Coming up, the U.S. imposing sanctions on Hamas.
The United States is announcing new sanctions targeted at Hamas's finances and meeting with our UK colleagues today to expand our efforts.
From Israel to China, geopolitics tensions simmering across the globe. Our team coverage coming up next in markets. A bit of a reprieve after a pretty difficult week.
The United States is announcing new sanctions targeted at Hamas's finances and meeting with our UK colleagues today to expand our efforts. Today's actions go after targets and their additional assets in Hamas's investment portfolio and individuals who facilitate sanctions evasion. Today's designations also underscore the critical role Iran plays in providing financial, logistical, and operational support to Hamas and our commitment to curtailing these activities.
As you just heard there and reiterated by Janet Yellen yesterday, the U.S. is targeting Hamas with a second round of sanctions, the latest effort to restrain the terrorist group there nearly 3 weeks after its assault on Israel. But President Biden also has his eye on growing tensions in Asia. The South China Sea, now an area of concern as the Philippines, a U.S. ally, pushes back against recent Chinese incursions. Meanwhile, amid all of this, Chinese Foreign Minister Wang Yi, the top diplomat to Xi Jinping, is in D.C. and expected to visit the White House today to meet with National Security Advisor Jake Sullivan. Let's get to our team coverage when everyone is so focused on what's going on in D.C. Our ACE team, Bloomberg's Emery Hordearn in New York, Kaylee Lyons in Washington, D.C. Emery, I want to start with you on this Hamas funding issues and how much these sanctions are viewed as actually helping to curtail that group that has been designated as a terrorist organization by the United States.
Well, for years, there's already been sanctions on Hamas, and they have not curtailed Hamas's actions or growth. And that was very evident on the October 7th massacre in Israel. But what you see now is OFAC and Treasury expanding that list. They are trying to make sure that any financing that goes to Hamas is cut off. So you have things like a CEO of a company in Sudan that allegedly is sending money to Hamas. He's going to be cut off. This is a financier. You have a Jordanian man living in Iran who many say is the representative for Hamas in Iran. He is going to be sanctioned. So the U.S. is trying to go after anyone that is left that has these links to financing and funding of what the U.S. calls a terrorist organization.
And we did just get this headline that U.S. is sanctioning individuals and entities for supporting Hamas. Kaylee, on the other side, we do have this top diplomat to Xi Jinping in Washington, D.C., has already met with others in the administration, now set to meet President Biden. How much does this represent an easing in tensions as we see what's percolating out in the South China Sea?
Well, Lisa, so often in the relationship between the U.S. and China, we see one step forward toward normalization and then sometimes step backward. Now, step forward is indeed what they're looking for here in D.C. As Wang Yi met with Secretary of State Antony Blinken yesterday. Wide-ranging discussion that will continue today alongside Jake Sullivan. And as you say, Lisa, there will be a meeting at the White House, according to Bloomberg's reporting, between Yi and President Biden. The question is whether anything can derail progress like what we're seeing in the South China Sea, because, of course, the U.S. has a close relationship with the Philippines. President Biden over the last week has reinforced that the U.S. will have an ironclad defense arrangement with the Philippines. And there has been a lot of tension between the Philippines and China in territorial waters in the South China Sea. Really, not without getting too wonky here, it's around a World War II era ship that has been grounded and that the Philippines uses to really reinforce its territorial claim over those waters. And there's been a lot of activity there and run-ins in recent weeks. So whether or not there's an escalation, or if the U.S. were to step things up to support the Philippines, could that be seen as some kind of provocation that risks derailing progress the U.S. and China is making? And of course, we are now just weeks away from a potential in-person meeting between President Biden and Xi Jinping that could happen in San Francisco at the APEC summit next month. President Biden has been hinting for a long time he would like to meet Xi this fall, but we haven't actually gotten confirmation from the Chinese that Xi will be making an appearance next month.
Kayleigh and Marie, both of you, thank you so much as we parse through all of these events. Still with us, we are so pleased to say, is Tony Rodriguez and Margie Patel with the line reestablished. Our apologies once again. Margie, I want to go to you on the geopolitics of the moment. How much do you see this as weighing on equity valuations at a time where the top performers have been delivering in their earnings but still getting punished?
Well, I think it shows you that the trends are still in place, which is the economy is in good shape. The strong sectors continue to grow, such as technology, such as those part of industrials that are benefiting from the capital expenditure cycle. And I would say that there's only a limited connection between what the Fed is doing and the market. But I don't think the geopolitical is really weighing on the market. We've had a little lift in some of the defense names, but it hasn't really changed the fundamental positioning in the market.
Well, given that, Margie, some people are saying that there is looking for a reason to sell. We saw this yesterday from Julian Emanuel of Evercore ISA, because otherwise a lot of these earnings from the tech giants have been good. Do you view this as an opportunity to come in after the correction that we saw, or do you see this as too early? That frankly, there is something else weighing on things if it's not just the geopolitics at the moment?
Well, I think to have short rates at around 5.5% is definitely something that's drawing money away from the equity market. We haven't had those rates in well over a decade, and it looks like we should continue to have abnormally high Treasury rates compared to where you'd think historically, depending on the inflation rate, simply because there's so much supply of Treasuries. So I think that's going to put a little bit of a lid on how well fixed income securities can do. But in the equity market, I still think that looks pretty attractive because it's going to be more responsive to earnings growth. And as you saw by the numbers yesterday, the economy really is surprisingly strong, and people looking for a recession have still been disappointed.
Tony, how much are you seeing a new buyer base come into the bond space in terms of people who previously were equity buyers who are getting enticed by yields at these levels?
Sure, Lisa. So in terms of like the front end of the curve, very short rates, 2-year to 5-year, a lot of individuals are investing in the Treasury market and fixed income markets and saying mid-single-digit returns. They look attractive to me given all the uncertainties out there. And when we go out to the longer end of the curve, you have a lot of total return-oriented buyers, endowments, foundations, pension plans, insurance companies, who, again, are also looking at returns in the 6 to 7% area for investment-grade credit and saying that meets my return target with much less volatility and risk than when we were at zero rates and I had to have a 90% equity portfolio to have any chance of achieving that return target. So those kinds of investors are looking at fixed income yields and saying we have pretty attractive return potential over the next 12 months.
Margie, how much do you see that as sort of the counterpoint to what you're saying, that people are going into equities because there's less of this sort of existential risk around refinancing, the Bank of Japan and all sorts of international buyers that might be stepping away, equities might be a haven from that. But on the flip side, the yields are delivering what you used to get in equities.
Well, yes, that's right. And I do think that the very short part, the Treasuries and money market type securities are drawing money away, but I'm not sure it's really drawing so much money away from equities or other long fixed income. I think it's really just taking away low rate deposit money flowing where the rates are higher, which is money market returns, and now CDs are starting to pick up. But I don't think we've seen really a fundamental shift in asset allocation. It's pretty hard to do if you've had disappointing equity performance, which many people did last year and even this year, to sell at big downdrafts and go into another sector that has only limited opportunity, which I would say Treasuries do. I think you have to be worried about this continuing supply of Treasuries, limiting the likelihood of getting lower Treasury rates in the next year or so.
Which raises a question, Tony. Are people moving away from 60-40?
You know, there's definitely a lot of questions about 60-40. Our view has always been that if you think the 40 is the Bloomberg Aggregate Index, which is really a highly concentrated Treasury mortgage portfolio, very high quality, that you should be diversifying away from that. There's so many more opportunities in the broader credit markets, moving into high yield, leveraged loans, preferred, CLOs, et cetera, that you do want to have a more diversified fixed income portfolio than what the traditional 60-40 looked like. But from the standpoint of I haven't, again, looking for an 8% return to meet my objectives. I think now fixed income, which was uncompetitive for over a decade in terms of that equation, now has a much stronger role to play in terms of a balanced portfolio. But you need to diversify beyond what the 40% traditionally offered you.
Margie, just a final word here. I know that you've traditionally been a bond investor who's gone much more into stocks because you see there's a better valuation opportunity there. Are you starting to shift back at all into bonds?
Well, I do think the top part of the high yield market, say companies rated BB, is really getting to be attractive. Those yields are between, say, 8 and 9.5%, which really is getting into the realm of competitive with equity. Also, many of those bonds are trading at discounts of 5 or 10% from their face values. So that gives you a little cushion. Also, I think the high yield market is much better than some of the other markets like loans. I think if we see defaults go up, it will be in the loan market, not in the high yield market, which is refinanced over the last decade and is better quality than we've ever seen.
Margie Patel, Tony Rodriguez, both of you, thank you so much. Have a wonderful weekend after this tumultuous week. Coming up, the morning calls, and later, Amazon topping earnings estimates after big tech enters a correction. That conversation still ahead with Loop Capital's Rob Sanderson and TPW's Jay Pulaski. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Ferro. Just quickly, we are seeing gains into the open. Time now for our morning calls. A look at some of the analyst recommendations this morning. First up, JP Morgan downgrading Regions Financial to neutral, forecasting a challenging outlook after earnings provided limited catalysts. Next up, Cantor Fitzgerald upgrading Rivian to overweight, $29 price target, expecting solid demand to continue throughout 2024. And finally, HSBC upgrading Intel to hold after earnings, noting management's solid execution and improving PC demand. Coming up, TPW's Jay Pulaski joining us at the opening bell, plus Loop Capital's Rob Sanderson on Big Tech. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Ferro. Moments away from the start of trading, and you can see buy the dip is the theme of the day, up 0.8% for the Nasdaq after entering correction yesterday. You could see S&P futures up a lot less, up 0.4%. Outside of stocks, you could see in the yield space, yields inflecting higher after that spending boost that we just saw. 10-year yields just marginally higher. It's pretty quiet today, 4.86% rounded up. A bit of euro strength now. It's been bouncing around all morning, and crude off some of the earlier highs, but still up solidly 1.3%, $84.25 in the NYMEX, as people get concerned about possible escalations in the Middle East. One stock to watch at the opening, it is Amazon. Shares jumping after delivering robust sales and profit growth. CEO Andy Jassy saying, quote, our cost serve and speed of delivery took another step forward as AWS growth continued stabilizing. Bloomberg's Ed Ludlow has more. Ed, what do you make of this? They actually did not beat, but they're still getting rewarded.
Yeah, that's a pretty good summary from Jassy of how investors have responded as well. Take a look at the shares. We're on track for our biggest jump since the first week of August, now up almost 6%. Cloud growth was around 12%, slightly below expectations for a dollar figure, but actually sequentially, this was the first time we'd had quarter-on-quarter growth in quite a long time. And the commentary from Andy Jassy did a lot of work as the catalyst to move shares in after hours. He did talk about the business stabilizing and said that they had added new customers in the early stages of the current period, in other words, the fiscal fourth quarter. Lisa, go back, compare and contrast what we talked about earlier in the week with Alphabet and Google Cloud. Because I asked Ruth Porat directly, did you add new customers in the quarter related to generative AI? And Ruth Porat didn't answer the question. Andy Jassy did. He said specifically, we have added new customers. And in the generative AI use case, it's going to be a platform for growth for a really long time in the AWS context. AWS accounts for the majority of operating income. That's been the case for quite some time. But on the bottom line, there was a lot of evidence that the work Andy Jassy's done to cut costs has worked. You look at some of the numbers in terms of the bottom line. Operating income, $6.98 billion. It's almost $1.5 billion more than analysts have been expecting. You're looking at record operating margins for that business going back many quarters. So that was good there. And then all the other things that we associate Amazon with, Amazon.com advertising, also beat expectations. So we can get deeper into it later in the show, but across the board, good, with the exception that a technical miss on cloud was forgiven by investors because of the forward-looking commentary.
Thank you so much. Turning now to chips, Intel predicting a return to sales growth in the fourth quarter. The CEO saying, quote, while we're encouraged by our progress, we know we still have plenty of work in front of us. The return of the personal computer. Bloomberg's Abigail Doolittle has more. Abby.
It does seem that there is a return of the personal computer. It was a very strong quarter, a very clean quarter. They beat earnings by 91%. Sales, that was very impressive to analysts and investors, beating 4.6% in the quarter that was. But what's really jazzing traders is exactly what you're talking about. The guidance for the fourth quarter having to do with the sales range that they've offered of $14.6 billion to $15.6 billion, being above the estimate of $14.4 billion, and the profit for the upcoming quarter is also expected to be stronger, having everything to do with a demand for chips. Because other areas of the business, there was a little bit of a slowdown, but some analysts are saying that they've really worked through an inventory here. And the big deal about the guide for the fourth quarter for both the top and the bottom line is it's that return to growth. They've been in an earning drought. I'm looking at the Bloomberg FA function here, Lisa, and quarter after quarter of negative sales growth. Well, for the upcoming quarter, it's expected to be 5.4%. For the first quarter of next year, 21%. So it's not just a limited event, potentially. It looks like it's going to be a trend. The stock on the year coming into today up more than 20%, jumping on the day. Its best day since November of last year. Investors are very encouraged by what they've seen out of Intel.
Abby, thank you so much. And tune in to our interview with the Intel CEO at noon Eastern today. Turning to autos, Ford falling short of Q3 estimates and withdrawing its forecast a day after negotiating a tentative contract with UAW. CEO Jim Farley saying, quote, we were negatively impacted by the strike and our cost and quality remain a drag on our business. Isabel Lee has more. Isabel, this rhymes with what we heard from GM withdrawing guidance.
Hi, Lisa. So there are two stories here, really. Ford missing its third quarter earnings and Ford withdrawing its full year outlook for 2023. And it really comes down to the effects of the union workers' strike, which lasted for around 6 weeks. It cost Ford around $100 million in the third quarter and a total of $1.3 billion so far. So let's tackle earnings first. Ford posted adjusted earnings EPS of 39 cents, that's 9 cents higher than the previous year, but below the estimated 47 cents. Ford's revenue of $43 billion was better than expected, though, but its EV sales plunged 46%. The CEO noted that Tesla has set a good benchmark by trimming costs and really scaling its output. And when it comes to pulling guidance, there is a tentative labor agreement reached. Union leadership will vote on October 29. I won't go too much into detail, but the CEO said that this will add an additional $850 to $950 per vehicle. And Barclays is saying that this new contract could cost Ford around $2 billion annually. So if you ask Morgan Stanley, though, the pulling out of the guidance isn't really surprising because, for instance, its rival General Motors has also suspended its guidance. Lisa.
Isabel, thank you so much. And turning now to big energy, Exxon providing an unexpected dividend boost and posting a surprise cash flow increase. The CEO saying our disciplined operational and financial performance will position us to deliver profitable growth and attractive returns to many years to come. Joining us for more is Bloomberg's Simone Foxman. Simone.
Yeah, despite that dividend boost by Exxon, investors reacting to both their earnings as well as Chevron's with a bunch of disappointment. Both companies missing estimates per share pretty substantially. Chevron reporting adjusted EPS of $3.05 versus an estimate of $3.71. Exxon $2.27 versus an estimate of $2.36. And Exxon seeing particular weakness in its chemicals earnings, collapsing 70% from the second quarter and may get worse in the fourth quarter. It has the largest chemical footprint of any major, but it is a small part of its business. And that may be part of why we're seeing this divergence between Exxon and Chevron shares. This quarter, Exxon announcing that it had achieved its goal of reducing costs by $9 billion a year from 4 years ago. And CEO Darren Woods also talking about lithium in Arkansas for the very first time, calling those plans more and more promising. Meanwhile, Chevron, it had already had an announcement on dividends and buybacks growing earlier this week. And also there's a lot of focus on its acquisition of Hess, which may be very expensive, at least more expensive than the Exxon's offer to buy Pioneer. But, you know, I think if we look at these shares, energy's been a bright spot lately in the market in the second half. You know, S&P Energy Index up 6.5%, but Exxon and Chevron have not really been driving that. And we're looking at these moves even on a day when WTI is up over 1%, Lisa.
Simone, thank you so much. And tune in to our interview with Exxon CEO Darren Woods at 10:30 a.m. Eastern. Meanwhile, stocks edging higher, but still on pace for a third consecutive week of declines. Our next guest recommending investors remain calm, writing, quote, "It sure feels like testing times." From UST volatility to poor stock market breadth to the war in the Middle East, the good news is there's little to suggest we face another October 1987. The bad news is that the path through the transition, the path to stability, and the $1 trillion reward remains a work in progress. I'm pleased to say Jay Pulaski of TPW joining us now with more. So translate that. Are you bullish or bearish? Are you basically one of the buyers who are buying this dip that we see this morning?
Yes, Lisa, good to be with you. And we remain constructive on risk assets. And look, it's been a situation where good economic news has been bad for stocks because of concerns about inflation and rate worries. We've been in a seasonal tough period. Our concern is that there has been some technical damage to stocks. Most sectors, most big indices, and many stocks are now below their 200-day moving average, which is a bit of a concern. But what keeps us constructive is that underneath the kind of poor headlines is pretty good data, and pretty good data across the board, whether you want to talk about manufacturing, whether you want to talk about growth, whether you want to talk about inflation, and most importantly, as you've touched on this morning, whether you want to talk about earnings. So that last bit in particular, earnings growth, is what's keeping us constructive on U.S. equity and equities globally as we look into Q4 and, more importantly, into 2024.
All right, let's dig into earnings. I've been struck this week that the forward guidance, that the prognostications of the CEOs and the CFOs have carried more weight in markets than the nuts and bolts of what the numbers show, which is not normally typical. The idea that Alphabet didn't get a boost from saying that they were going to go into AI, but Meta saw a big decline, at least in the initial throes of it, from suggesting that they don't know what's going to happen with advertising spending. Who does? And then Amazon coming out and allaying any concerns about losing cloud dominance by saying things are going to look really good. And hey, AI, why do traders hook into some of this and not into others?
Yeah, no, that's a great question. And it's a great, weighing machine and leveling machine, which is the stock market, right? And so, as you know, we focus on ETFs in particular and more of a macro asset allocation perspective than individual stock picking. So for us at TPW Advisory, the focus is really on earnings growth overall for the broad market. And JP Morgan just came out this morning noting that with about 30% of the S&P reporting, earnings growth for the U.S. is up 12% year over year. The consensus going into the quarter, into quarterly earnings, was 1% plus or minus. And the guidance going forward has basically been muted, but we take that as a sign that the 12% earnings growth that is currently consensus for 2024 is intact. And if that's the case, then it's hard to see continued declines in stocks, but albeit that there has been technical damage and markets are unsure, and therefore you have kind of a trend of recent selling. The good news from our perspective is that we believe we're coming into a seasonal period which is very constructive, the best 3 months for stocks, November, December, and January. We have an environment where economic growth is fine, earnings growth is fine, and we think the surprise is going to be, Lisa, as we go into 2024, the surprise is going to be that inflation comes in better than expected. That caps the Fed, that caps rates, which already look like they're capped, and importantly, that suggests that the dollar is capped and starts to roll over. And those things are all constructive for risk assets as we look into next year.
The nirvana of a soft landing, how much does that get challenged by the idea that we got an upside surprise in spending? And that it seems like, I mean, I keep going back to this cliche, don't get between an American and a cash register. It has continued and persisted, at least what we saw this morning.
Yeah, we remember we've been focused on 4 guideposts, right, as we look to that unlock that stability reward you in my earlier writings. One of those is disinflation. We just talked about that. We think the surprise is going to be lower than expected inflation. The second, manufacturing recovery. U.S. PMIs above 50, China above 50, Europe bottoming. The third is earnings, we just talked about. Fourth is China, where we look to see the data as better than expected, fiscal stimulus. So we're constructive on growth continuing through next year. And we think the global economy, if we look at the 3 big regions, right, tripolar world, 3 regions, Europe is bottoming, Asia is picking up, both China and Japan, and the U.S. is in relatively good shape. We're not going to grow at 5% as we just did in the Q3, but we're not going to go into recession. When you look at the quarter-over-quarter growth in the U.S. going back the last 3 years since COVID, it's pretty hard to not see the first half of 2022 as the recession, 2 down quarters. We don't see any sign of recession in the U.S. in 2024. Consensus earnings growth is 12%. We're going into 2024 with a decent head of steam. And the good news is that inflation continues to decline. And if you look at the PMI data that just came out this week, it was very solid, suggesting that inflation is trending towards the 2% Fed target by mid-next year. That's a full year ahead of where the Fed is expecting inflation to be. So if we get continued decent news on the disinflation side, rates don't go any higher, dollar rolls over, and that's, as we said, that's really the playbook as we see it, and we've become more comfortable with that over the last couple of weeks.
Jay Pulaski, we hope that that case comes to pass. Thank you for being with us. Coming up, Amazon boosting sentiment after a challenging week for tech results. That conversation coming up next with Loop Capital's Rob Sanderson.
AWS, it's not a matter of if. We know public cloud is very early days. We know AI adoption and deployment is early days. So, when you have 2 really important divisions that are all, have much bigger growth tailwinds going forward, there's not a lot of companies that can say all of that. So I think Amazon has much more upside return than all the other Magnificent 7 names.
That was Eric Clark of AccuVest. Amazon signaling a boost for its cloud business as sales topped estimates. CEO Andy Jassy saying, quote, generative AI represents tens of billions in potential revenue for AWS over the next several years and growing very, very quickly. The market took this and ran with it. Ed Ludlow back with us from San Francisco. Ed.
Yeah, took it and ran with it. And even though it was a slight top-line miss for AWS, as we discussed earlier, the market kind of forgave them in part because the bottom line was so impressive in terms of outperformance, more than almost $1.5 billion of operating income, more than the street was expected. And it kind of sets up this really interesting earnings season, right? Earnings are important again, and that was a reference just then to the Magnificent 7, but we've been thinking about the big 5. Alphabet, Microsoft, and Amazon have all reported their earnings, and on a year-on-year basis, we got the massive adjusted EPS growth that we were expecting. Those big 5, 2 to come at Apple and Nvidia, and as a 5, the expectation is that we see average EPS growth of 34% year on year. The S&P 500 overall is expected to have EPS growth that's flat. And if you took out those 5 big tech names, you would see EPS decline by about 5%. Apple's the exception to the rule. And I know that you're very excited about Apple. I am too. But its forecast have top line deceleration and modest EPS growth. So let's see what we get.
Ed, thank you so much. Rob Sanderson weighing in on Amazon's results, writing, quote, results should ease recent concern. We think commentary on AWS deal momentum and strong interest in Gen AI solutions will shift investor focus away from slowing growth. Rob maintaining a buy rating on the stock with a $200 price target. And he joins us now. Rob, why is it that the market took Amazon's word for it and didn't take Google's word for it when they talked about the promise of AI?
I think above just the Gen AI commentary, don't overlook the fact that they had incredible bookings momentum coming out of September, to the extent that the total deal volume in September was greater than all of Q3 combined. So, it's not only the Gen AI commentary, but this points to a meaningful reacceleration in AWS revenue growth, and that's quite different than what Google reported. They missed on cloud revenue by about 400 basis points, and said they're now stomaching some of the headwinds of cost optimization that Microsoft and Amazon have already sort of had a year's worth of headwind from that dynamic. So it's not only Gen AI that has, I think, people interested. It's the potential for reacceleration in cloud revenue growth, I think, is probably the larger factor here.
And right now what I'm seeing is that Google shares are lower on the day, even as all the others are continuing to see some buy the dip momentum. Rob, do you think that's the big takeaway from the earnings so far in the big tech space, that what you're seeing is a dominance of both Microsoft and Amazon at the behest of Google?
Yeah, that would be the takeaway from this quarter in isolation. I mean, that's the trends that the numbers were suggesting. And, Google had performed better in the trailing 4 quarters, and it's kind of catching up to them now. But they're a distant third in this race in just cloud services in general. Does AI get them in a better position over time? That's yet to remains to be seen. But yeah, that's the takeaway coming out of earnings from this single data point in this single period.
One thing that's gotten clear from the Magnificent Seven is just how different these stories are in terms of which specific economies they cater to, whether it's the spending of businesses or whether it's consumer spending. What have we learned in terms of what the trends are leading into Apple's earnings next week?
Yeah, consumers mixed. It's still pressured. Amazon results were solid on top line. Their guidance was a little bit light. There's a big margin recovery story that's happening beneath the surface on retail, and there's an awful lot of earnings power in the retail business. They doubled their plant capacity coming out of COVID, and the unit economics in their retail business are really upside down right now. I think that's being masked, and the earnings power is yet to show through. They're losing quite a bit of money for every package delivered, and there's a long road ahead to restoring margins in the retail business. So in terms of consumer spending, it's still pretty squishy, and the Amazon results and outlook would sort of support a pretty tepid consumer.
How much is geopolitics going to really reign supreme in Apple's earnings calls, given what we've seen with China production and the potential competitive landscape?
Yeah, it's a risk. How much that shows up in over what time frame, I think, remains to be seen. But it's definitely something that investors have to take very seriously when they're evaluating what might happen next on the geopolitical front.
Rob Sanderson, thank you so much for being with us on a day where we do see a bit of a lift, a little bit of a buy the dip kind of moment following a correction that really entered that 10% territory yesterday after the earnings had already come out. A big question about why some companies are seeing a gain from some of the commentary and others not so much. Coming up, the market moving events that you need to be watching. That's next in our trading diary. Today, you can see that reprieve continue as the session grows older, about 23 minutes into the session, and still the NASDAQ leading in a bit of a rebound. Bloomberg's The Open. I'm Lisa Abramowicz in for Jonathan Ferro. Let's take a look at the markets. You can see it fading as the session grows older. The Nasdaq still, though, holding on to those gains, up 0.9%. Outside of stocks, you can see in bonds, yields actually clawing back some of the gain that they had previously seen. Again, there's something going on in markets. Time now for the trading diary. You need to be watching next week. Tuesday, U.S. consumer confidence, along with the BOJ rate decision. Wednesday, an FOMC rate decision, followed by a Chair Powell news conference. We'll also get ISM manufacturing and job openings data, as well as a refinancing agreement from the Treasury Department. And Thursday, central bank decisions continue with the Bank of England, and then we round out the week with the October payrolls report on Friday. Today, it feels like a reset day after a tumultuous week. We've really tried to go up and down. The volatility is sort of benumbing traders to try to set and wait to understand the new paradigm. Maybe next week, when we get all of these central bank decisions, we'll get a better clue. This was Countdown to the Open. This is Bloomberg.